Elon Musk is estimated to be the world's richest person as of February 2026 with a net worth of $845 billion. That single fortune is larger than the $295 billion held by the entire Forbes billionaire list in 1987. Back then, the list had 140 names. Today, it has over 3,000. This is a staggering accumulation of capital. Yet Gabriel Zucman, a professor at the Paris School of Economics, told the Financial Times that these individuals happen to be the ones who pay the least tax. It is a bizarre paradox. The more you have, the less the tax code seems to apply to you. Is it because these people are all fleeing to Dubai? Or is it because they have found a way to make their money vanish while it is sitting right in front of us? Whenever a city like New York or a state like California suggests a new tax, the immediate counter-argument is that the rich will leave. The Economist reports that New York's mayor, Zoran Mamdani, is pushing for a 2% city tax on incomes over $1 million. Critics claim this will trigger a mass exodus from New York. They point to headlines about 800,000 people prepared to leave the city.
The election of Zoran Mamdani as New York City mayor already sparking an exodus out of New York.
Escape from New York? The tax base has been fleeing the Empire State.
It sounds like a total collapse of the tax base. If you try to increase revenue from the rich, they will just leave, taking their jobs and their spending with them. Ironically, by trying to fill a broken budget, you might end up shrinking it. But is this reality or just a very expensive ghost story? The Financial Times notes that tax flight happens less than most people think, but it does happen. A few high earners have reportedly left the United Kingdom or signaled their intent to do so following changes to the non-domiciled tax regime. Yet, the truly wealthy do not necessarily need to change their zip code to protect their billions. They use a different system that bypasses the concept of income entirely. To understand how this works, we have to look at the actual accounting of extreme wealth. Most people live in a world of realized gains. You work, you get a paycheck, and the government takes its share immediately. The super rich live in a world of unrealized assets. They have equity, and it operates around this three-step process. The first part is the buy phase. You acquire assets that grow in value, like founders' stock in a technology giant or loads of commercial real estate. As long as you do not sell, you don't owe the taxman a cent. But you cannot buy a yacht with unrealized stock. Or can you? Instead of selling your stock and triggering a capital gains tax, you go to a bank. You ask for a loan using your massive portfolio as collateral. The bank is happy to oblige because your assets are worth billions. You get millions of dollars in cash to fund your lifestyle. This is the second phase. This cash is a loan. Loans are not taxable income. You have successfully generated liquidity without a taxable event. Robert Armstrong in the Financial Times points out that bank lending to shadow banks, or non-depository financial institutions, now accounts for $1.7 trillion in bank loans. This shadow banking system acts as the quote umbilical cord for this type of high-end rental money. Finally, there is the die phase. This is the so-called step up in basis. When a billionaire passes away, the cost basis of their assets is reset to the current market value for their heirs, without anyone needing to pay any tax on the assets. The Economist calls this the resetting of the basis, and notes it allows billionaires to avoid the levy entirely. The hundreds of millions in growth that happen during their lifetime simply evaporate from the tax ledger. It is a perfect loop. Buy, borrow, and then die. The plan has worked almost perfectly, but the public has started to notice. As pre-tax inequality has soared, the pressure on governments to act has become overwhelming. But who exactly are they going after? The Economist argues that today's taxman is less balanced and more like Robin Hood, taking from the rich and giving to the poor. Their analysis suggests that 7 in 10 countries have more progressive tax systems today than they did in 1990. In the United States, the top 1% made up 16% of pre-tax income in 2022. That number was only 9% in 1980. It sounds scary. Yet, thanks to redistribution, the average Gini coefficient, a measure of inequality, has actually fallen slightly across the group of 7 nations. Governments are essentially using the rich as a giant ATM to fund the rest of society. In Britain, the top 1% now account for nearly 27% of the total income tax take. Jeremy Hunt, the former British Chancellor, even boasted in 2024 that the average earner in the United Kingdom had the lowest effective personal tax rate since 1975. But here is the catch. This Robin Hood state creates massive economic friction. When you tax a banker or a lawyer in New York, they face a combined federal, state and local top rate of 52%. The Economist cites research finding that a 1 percentage point higher income tax rate reduces the likelihood that someone will file a patent in the following 3 years by 0.6 percentage points. We are taxing the visible rich, meaning the professionals and innovators, while the billionaires are still using the borrowing tactic to avoid paying taxes. If the current system is failing to capture the top 400 families, can a new, more aggressive type of tax fix it? California is about to provide the world with a very expensive answer. Voters in the Golden State may soon face a proposal for a one-time 5% levy on billionaires' wealth. This is not a tax on income, it is a tax on the value of everything they own. It looks less like progressive taxation and more like what The Economist describes as an arbitrary seizure of property. Billionaires like Sergey Brin and Peter Thiel have already moved portions of their business interests out of California in protest. If one state can take 5% of your net worth today, what stops them from taking another 5% next year? The Economist warns that no one should expect the promise that it is a one-off levy to be honored. It is a safe bet that once a government finds a new source of cash, they will return to it the next time a budget breaks. On one side, you have governments burdened by aging populations and legacy debts. On the other, you have a disconnected elite that is increasingly mobile and less attached to the country that made their wealth. Pascal Saint-Amans, a former head of tax at the OECD, told the Financial Times that if you ask a billionaire where their loyalty lies, most would say, "My loyalty is with my money." Is the global economy heading toward a race to the bottom where countries compete to offer the lowest rates to the super rich? Or is the net finally closing? While California's one-off rate looks like a property seizure, other nations are attempting to build a permanent cage for mobile capital. Gabriel Zucman is campaigning for a global 2% tax on billionaires, arguing that advances in tax transparency and the end of bank secrecy mean it is finally possible to track these hordes. But the race to the bottom is already in full swing. The United Arab Emirates and Italy have rolled out the red carpet with fiscal regimes designed to attract high-end earners. Italy, for instance, offers a fixed fee of 200,000 euros a year for those seeking tax residency. For someone worth $10 billion, that is an effective tax rate of almost zero. This high-end nomadism creates what Pascal Saint-Amans calls a disconnected elite. These individuals benefit from a country's infrastructure and access to its markets while paying less than the people who serve them coffee. It is a system that fuels populism. If the people at the top aren't contributing to the broken budgets of the cities they live in, the social contract begins to struggle. But even if we successfully charge the billionaires, would it actually solve the problem? The math suggests otherwise. The Economist points out that California's proposed wealth tax would raise only about 2% of the state's annual output. In New York, Zoran Mamdani's proposal would bring in a mere 0.25% of output annually. These sums are trifling when compared to the massive costs of healthcare, defense, and aging populations. There is also the so-called wrong-way risk hidden in the banking system. Robert Armstrong explains that when banks lend to non-depository financial institutions, they think they are laying off credit risk. In reality, they are exchanging it for counterparty risk. If a market crash hits the assets used as collateral for those buy, borrow, die loans, the banking system could find itself taking on the risk for the very billionaires it was helping to shield. We saw a small preview of this in 2025 when JP Morgan Chase and Fifth Third recorded losses on a warehouse loan tied to a bankruptcy. The financing between shadow banks and traditional banks means that if the rich lose their money, the depositors might lose theirs too. So where does that leave us? Fiscal systems designed around income and consumption are struggling to capture wealth that moves at the speed of light. We are left with the choice between taxing activity, which discourages work and innovation, or trying to tax existence, which encourages the rich to move to Dubai or Singapore. The Economist concludes that emulating Robin Hood by taking from the rich and giving to the poor is a trap. A society where a few pay for the many is fundamentally weaker than one where everyone has a personal stake in keeping government spending in check. In the end, the focus on taxing the rich might be less about balancing a budget and more about managing the optics of a world where growth has stalled. We've created a system that is incredibly efficient at generating wealth, but increasingly bad at justifying it to the people who aren't in the top 0.0001%. How do the arguments against taxing the rich sound? Do you think the economists are onto something, or is this another trick by the billionaires? If you enjoyed this video, please subscribe to learn more about the world. Check out some of our other videos on similar topics. Thank you for watching.